The market prices artificial intelligence as if it operates in a vacuum, treating large language models as an unconstrained asset class capable of frictionless scaling. Financial models often reinforce this. They price AI companies based on historical SaaS metrics, assuming that adding a new user or generating another billion tokens carries near zero marginal cost. But macro models possess a critical blind spot. Software is abstract, but execution is physical. Every prompt and every line of code requires physical silicon to process it. The reality of semiconductor manufacturing is a stark contrast to the software dream. Building an AI chip demands hyper-sterile cleanrooms and highly specialized manual labor, physical constraints that cannot be bypassed by writing better code. The global AI rollout is strictly capped by manufacturing bottlenecks buried deep in the semiconductor supply chain. By ignoring these physical limits, institutional investors are mispricing the entire sector. They are staring at the software layer and missing the capital rotation happening right beneath it. The bedrock requirement for any advanced AI chip is extreme ultraviolet lithography, or EUV. Only one company on Earth, ASML, builds the machines capable of printing these circuits. This is an EUV lithography system. It is a train car-sized piece of heavy industry, packed with dense piping, specialized optics, and lasers. These machines are extremely scarce. ASML expects to ship only 65 low-NA EUV units this year. Global hyperscalers like Meta, Amazon, and Google are currently locked in a zero-sum game, spending tens of billions to secure the compute capacity generated by those exact 65 machines. The output of these systems dictates the physical speed limit of the global AI expansion. To understand why this supply chain is choking, we need to look at litho intensity. Advanced AI chips require a silicon weaver to pass through the EUV machine multiple times to print complex, layered patterns. This pie chart of ASML's Q2 net system sales shows that EUV machines account for 57% of revenue. That demand is cleanly split. 51% goes to logic chips, while 49% goes to memory. Under standard operations, an EUV machine running a single layer has a baseline throughput of roughly 300,000 wafer starts per month. But high bandwidth memory, the HBM required for AI GPUs, is not standard. It requires high litho intensity, demanding 5 or 6 distinct EUV layers per wafer. Dividing that 300,000 capacity by 6 layers drops the effective output to just 50,000 completed wafers per month. Furthermore, a single gigabyte of high-bandwidth memory requires roughly 4 times the physical wafer real estate compared to standard DDR5 memory. ASML is currently investigating future capacity increases, but equipment manufacturers often prefer to keep supply tight to prevent overcapacity and maintain profit margins. Given that these machines take up to 2 years to build, and orders are already booked through late 2027, the physical supply of compute cannot possibly catch up to projected software demand for the remainder of this decade. Securing a spot in this constrained supply chain requires a $1 trillion capital expenditure cycle from the major tech firms. Silicon Valley and Washington cannot secure this level of funding based on software returns alone. They require a high-stakes, existential narrative to justify the spending. The US-China AI race serves as the primary framing mechanism. Geopolitical fear unlocks institutional and sovereign wealth, which directly funds the hyperscalers' infrastructure build-out. The economic reality of this rivalry is quite different than the marketing. Efficient, open-source AI models developed in China drive broader hardware utilization globally, making sophisticated AI cheaper and easier to run on existing chips. Elites employ this race concept to stimulate investor urgency. Fear justifies continuous, unconstrained capital deployment. This manufactured competition functions as a marketing campaign to secure the capital required to buy out ASML's limited capacity. Capital markets are already recognizing these physical constraints and actively repricing the sector. The high-beta tech momentum trade is rapidly breaking down. AI software companies trading at 100 times forward earnings are facing steep drawdowns as investors question their long-term scalability. This market factor heat map illustrates a massive capital rotation out of speculative tech into foundational infrastructure. Deep negative outflows are concentrated in high beta tech and momentum as capital flees pure-play software. That money is moving directly into small cap value and the utility sector. The logic is simple. Boring utility companies, the ones providing electricity to data centers, are now the most reliable way to capture AI growth with lower volatility. Capital is simply migrating away from the speculative software layer, moving down to the tangible physical supply chain. Even if the lithography bottleneck is solved, the market faces a secondary hard limit: raw electrical power. Physical energy infrastructure is the new destination for AI capital. Data centers require immense, uninterrupted power loads that the current grid is not yet equipped to handle. As of mid-2026, data center REITs and regional power generation have replaced software as the primary choke points for institutional traders. The macro architecture stack illustrates this shift. Consumer-facing software layers are shrinking in relative value. Meanwhile, the foundations, semiconductors, data centers, and the power grid, are expanding as value flows into industrial commodities. Securing megawatts and square footage has become more critical to the trade than writing marginally better code. The limit to artificial intelligence is not algorithms. The limit is silicon lithography, capex cycles, and power grids. Institutional allocators must recalibrate their models and discard the assumption of frictionless software growth. Direct your focus to the hardware and infrastructure layers that hyperscalers are structurally forced to fund. To capitalize on this physical infrastructure build-out, investors must stop chasing software momentum and own the physical bottlenecks of the real world.